Welcome to the Deep Dive. Today we're tearing open the 2014 Fairfax Financial Holdings shareholder letter. It's quite a document from Chairman and CEO Prem Watsa.
It really is more than just numbers. It's about a specific culture hitting its 30-year mark. And for you listening, this is really about seeing how a company juggles, well, incredible success with some deep, deep worries about the world economy.
Yeah, that's our mission, pretty much. We want to break down how they hit record numbers, why they felt this urgent need to change their own governance rules, and what economic disaster Watsa was betting against while everyone else seemed optimistic.
It's a classic contrarian story, playing out in real time back then.
So let's dive into the performance side first. 2014 was apparently a monster year for them.
Oh, absolutely. A banner year. You look at the core operations. Record underwriting profit, $552 million US dollars. Record net earnings, too, $1.6 billion.
Wow. Okay. And the book value reflects that.
Yep. Book value per share shot up 19.5%, and that's after adjusting for dividends paid out. Really strong.
But the number that always jumps out with insurers, especially Fairfax, is the combined ratio. They hit 90.8%. It sounds amazing. Can you unpack that? Why is that such a big deal?
Right. Okay, so think simple terms like running a shop. The combined ratio measures your basic operating profitability before investments. It's your costs paying claims, running the business, divided by the premiums you bring in.
So 100% is break even.
Exactly. You just covered your cost. Anything below 100% is an underwriting profit. So 90.8% means for every dollar in premiums, they only spend about 91 cents on claims and expenses. That difference, that 9.2 cents, pure profit just from the insurance operation itself.
And that was their best ever.
Lowest in company history at that point. It speaks
Yeah.
volumes about their underwriting discipline, yeah.
Incredible discipline. So where was this strength coming from? Was it one particular area?
Well, a huge chunk came from their reinsurance arm, Odyssey.
Yeah.
They accounted for something like 65% of that underwriting profit. And get this, their combined ratio was even lower, 84.7%, just stellar. And Zenith, another big piece, also had its best year since Fairfax bought them. Their ratio was 87.5%. So it wasn't just one Shiro unit. The discipline was pretty widespread.
Okay, so this amazing underwriting success, it connects directly to Fairfax's secret sauce, right? The float.
Ah, yes, the float. Crucial concept. It's basically the money they collect in premiums that they hold on to before they have to pay out claims. Reserves, essentially.
Money they get to invest for themselves in the meantime.
Precisely. And the goal for any great insurer, certainly for Fairfax, is to get that float for cheap, or even better, for free. Ideally, you want the underwriting profit to cover the cost of holding that money.
And in 2014, they didn't just get it cheap.
They were effectively paid to hold it. Because the underwriting was so profitable, their average long-term cost of float for 2014 was actually a benefit negative 4.7%.
Negative cost. That's wild.
It is. Even looking back over the previous 10 years, their average cost was tiny, only 0.3% per year.
Okay, put that 0.3% in context. What was, say, stable government borrowing during that time?
Well, the Government of Canada, a pretty safe benchmark, right? Their 10-year borrowing costs over that same period averaged around 3.6%.
So Fairfax was getting its investment capital for 3.3% less than the Canadian government.
Yep.
That's it. That's a massive competitive advantage.
It's huge. It creates this enormous pool of very low-cost capital. End of 2014, they figured it was about $711 per share in float available. That's the fuel for everything else they do, especially those big contrarian investment plays we'll get to.
Right. The financial firepower is key. But firepower needs direction. How do they make sure that specific Fairfax way, that fair and friendly long-term culture, actually sticks around? This leads us to that governance puzzle they tackled.
Yes, a really critical moment in 2015, driven by the 2014 results and growth. See, the company had done so well issuing shares for growth and acquisitions that the voting power controlled by Prem Watsa and his family had actually been diluted. It went from over 80% way back when down to about 43%. And most of that, 41.8%, was held in special multiple voting shares.
So they were worried about losing that control block needed to maintain the culture, even though the company was succeeding.
Exactly. The special meeting wasn't about grabbing more power. It was about stopping the erosion of the existing control level. They wanted to lock in that 41.8% voting power derived from the multiple voting shares.
How did they propose doing that? Just stopping dilution?
The mechanism was interesting. They proposed increasing the number of votes per multiple voting share from 10 up to 50.
50 votes per share. Whoa. Okay, that sounds like the kind of thing governance experts usually hate cementing control without proportional economic interest. How on earth did they sell that to other shareholders?
That's the crucial part. Watsa bundled it with some really strong commitments and protections for the minority shareholders. It was basically a package deal. Let us keep this control structure to protect our long-term approach, and in return, we'll give you these guarantees.
Okay, what were the guarantees? Because that's a big ask.
Yeah.
Very big. First, a sale restriction. The family essentially promised not to sell their multiple voting shares except for internal family transfers, so they couldn't just cash out while keeping control.
Right.
Second, if that dual-class share structure ever ended, those multiple voting shares would convert one-for-one into regular subordinate voting shares. No special premium payout for having held the control shares.
So no personal windfall from the special shares themselves if the structure unwinds.
Correct. And then the really big personal commitment from Watsa himself.
The salary thing.
Yeah. He formally committed to stay on as CEO until at least the end of 2025, keeping his salary fixed at CDN $600,000 a year, which, by the way, hadn't changed since the year 2000.
Wow.
And he explicitly gave up any rights to bonuses or stock options. He tied himself to the mast, basically saying, my reward is the long-term success of Fairfax, same as yours.
That's quite a statement, linking his personal compensation directly to the need for this governance structure. It underlined the point. The control wasn't for personal enrichment. It was to allow him to make potentially unpopular, long-term, sometimes painful decisions like the hedges we'll discuss, without getting forced out by short-term market pressure.
Okay, that makes sense. But what about future growth? What if they needed to issue tons of new shares for a huge acquisition? Could that control just stay locked forever?
No, they built in safety valves, minority approval gates. If the total number of outstanding shares increased by a lot, say 25% or 50% over 5 years, the continuation of those special voting rights would need approval from a majority of the minority shareholders.
Ah, so the other shareholders get a say if dilution gets really significant.
Yes. And another one. If Watsa stopped being chairman or CEO, the whole structure would face another minority ratification vote within 5 years. Plus, a specific check for massive single transaction dilution, like issuing more than 50% new shares at once. That also needed minority approval to keep the protection intact.
So it's conditional control, dependent on performance, Watts' presence, and minority consent if major dilution happens.
Pretty much. A unique solution to preserve a unique culture.
Okay, so internally they're shoring up the structure. Externally, though, 2014 was also about major expansion, right? Big moves.
Huge moves, real confidence in their decentralized model. The headline deal was the agreement to buy Brit plc. That was a $1.22 billion acquisition.
Brit, that's a big name in London, isn't it? Lloyd's Market.
Exactly. A major global specialty insurer and reinsurer, big footprint in Lloyd's. Buying Brit gave Fairfax immediate scale and expertise in very complex, potentially profitable insurance lines. It was a serious power-up.
And funded partly by issuing more shares, which ties back into that governance discussion we just had.
Correct. They issued about 1.15 million subordinate voting shares for that deal.
Interesting. What else? There was a move into pet insurance.
Yep.
Seems a bit different.
It does, but it fits the Fairfax pattern of buying infrastructure almost. They bought Pet Health, based in Toronto, for about CDN $100 million. Now, Pet Health wasn't just selling policies. They were dominant in pet microchips, like the biggest distributor globally, and they made software used by animal shelters. So Fairfax wasn't just buying an insurer. They were buying into the whole ecosystem around pets in North America. A smart foundational play.
Yeah. That is clever. Infrastructure, like you said. Any other geographic moves?
Yep. They pushed into Eastern Europe, bought QBE's insurance operations in Hungary, the Czech Republic, and Slovakia, created a new platform, Fairfax Eastern Europe, targeting markets they saw as underserved or underpenetrated.
Spreading the bets. But the really big strategic bet seemed to be India, wasn't it?
Absolutely. Fairfax, India. This was clearly driven by Watsa's view on the political shift there, the election of Prime Minister Narendra Modi. He saw it as a major positive inflection point for business in India.
And they put serious money behind that.
Oh, yeah. They launched Fairfax India as a separate, publicly listed company, raised $1.1 billion in total. Fairfax itself put in $300 million, but structured it to get multiple voting shares, giving them something like 28% of the equity, but 95% of the votes. Ready to invest big in India.
And did they have early signs it was working? Any examples?
They did. Thomas Cook India, which Fairfax already controlled, was a prime example. Its wider group revenue, including acquisitions like Quest and Sterling Resorts, just exploded. Went from about $32 million in 2012 to nearly $400 million in 2014.
Wow, that's steep growth.
And Quest itself, a subsidiary focused on business services, saw its net earnings jump, get this, 363% in US dollar terms in just that 1 year, 2014. So yeah, the early results in India looked spectacular.
Okay, so the decentralized model, letting local managers run with things, clearly seemed to be paying off. And it wasn't just insurance or India doing well, right? The letter mentions other holdings, too.
That's right, it shows the breadth. You had Priory, the restaurant operator, almost double its EBITDA in a single year. Sporting Life, the retailer, grew sales by nearly 25%. So across the board, the operating companies were really firing on all cylinders in 2014.
Okay, record profits, successful expansion, governance secured. It sounds like clear sailing. But the tone of Watsa's letter wasn't celebratory, was it? It was almost grim.
Deeply cautious. That's the paradox. Here's the company having maybe its best year ever operationally. And Watsa spends a huge part of the letter sounding alarms about the global economy. He was worried.
Worried about what specifically? What was he seeing?
Two main things: deflation and a massive speculative bubble. He laid out the case for deflation pretty clearly.
What was the evidence he cited?
He pointed to actual price declines. The U.S. Consumer Price Index, the CPI, fell 1.5% in the second half of 2014. If you annualize that, it's like a 3% deflation rate.
Okay.
In the Eurozone, CPI was down 0.5% in the same period. And then look at bond markets. Germany issued a 5-year bond with a negative yield, minus 0.08%. People were literally paying the German government to hold their cash safely. That screams fear of deflation.
Thought for safety. And commodities were falling too, right?
Plummeting. He highlighted the drop since the 2011 peak. Oil down over 50%. Copper down nearly 40%, iron ore down 50%. It looked like demand was seriously weakening globally.
So signs of economic slowdown or contraction. But he also mentioned speculation, like a bubble.
Yeah, he called it the grand disconnect, especially in tech valuations, both public and private. He thought prices had become totally unmoored from underlying reality.
Any specific examples he called out? People love the examples.
Oh, he named names. Publicly traded stuff like Netflix trading at 111 times earnings. Facebook at 17 times sales. Just stratospheric.
Yeah.
And the private market, maybe even crazier. He pointed to Uber, valued at nearly 15 times all the equity funding it had ever raised. Xiaomi, the Chinese tech company, at almost 33 times its funding.
So just huge amounts of money chasing these companies based on hope.
Pretty much. Watts' view was blunt. Like all speculative booms, this one would end, and quote, very badly.
Okay, so deep concerns about deflation and a tech bubble. This obviously leads to Fairfax's famous hedges. How were they positioned defensively in 2014?
Given the deflation fear, their main weapon was a massive position in CPI-linked derivatives. These are contracts designed to pay off if inflation stays low or, even better, goes negative.
How big was this bet?
The notional value, the face value of the contracts was enormous. $111.8 billion at the end of 2014.
Billion with a B. That's a huge position. And these hedges weren't new, right? They'd been holding them for a while.
For years. And it had been painful. That's key. Just those CPI derivatives alone had cost them about $444 million in cumulative losses over the 5 years leading up to 2014.
Ouch.
And if you broaden it out to include all their equity hedges and other derivatives meant for protection, the total cumulative loss over that period was staggering, around $4.1 billion.
$4 billion in losses on protection. This is where that governance structure and the CEO's commitment become absolutely critical, isn't it?
Exactly. You need immense patience and control to stick with a strategy that bleeds that much cash for that long, waiting for your thesis to play out. Most public companies would face revolt. Fairfax could endure it because of the culture and the control structure.
So they're paying billions for downside protection. Did Watsa offer any other context for why he felt this extreme caution was justified?
Yeah, he pointed to a historical metric.
Yeah.
The Tate-E ratio for the S&P 500, that's the cyclically adjusted price-to-earnings ratio, kind of smooths out earnings over 10 years.
And where was it then?
It was at 28. Watsa made the point that the market had only been more expensive by that measure twice before in history, just before the 1929 crash and during the peak of the dot-com bubble in 2000.
So basically slashing red warning lights based on history.
That was the message. He was telling everyone, look, valuations are in nosebleed territory historically. Be careful.
Okay, let's try to pull this all together. We've got record operating results, smart expansion, a fortified governance structure, but overlaid with these dire warnings and costly hedges. What's the core takeaway from the 2014 letter?
I think it's about the power of consistency and conviction. Fairfax's model works because of, well, maybe three interconnected things. One, relentless focus on profitable underwriting. That 90.8% combined ratio is proof.
Okay.
Two, deliberately engineering the governance to protect the long-term culture needed to execute their strategy, even when it's unpopular or painful.
Right, the Watsa commitment.
And three, having the courage and the financial structure to maintain massive downside protection based on deep macroeconomic conviction, even if it costs billions in the short term. It's patience enabled by culture and structure.
And it's worth a quick mention, too, that hidden value idea. The letter points out nearly $1 billion in unrealized gains in subsidiaries that weren't even showing up on the main balance sheet due to accounting rules.
That's a good point. Companies like Thomas Cook India, Ridley, others, their market value or underlying worth was much higher than what the accounting rules let Fairfax officially record at the time. So always more going on under the surface.
Definitely. Okay, so let's leave the listener with something to chew on. A final thought.
Well, consider this. Fairfax willingly lost $4.1 billion on hedges over 5 years, waiting for a storm they believed was coming, while markets were soaring and the CPE ratio was hitting historic highs. When optimism is rampant, being cautious, being hedged is incredibly expensive. It costs you performance. It costs you actual cash. So the question for you is, what price are you truly willing to pay year after year holding on to a conviction that goes against the crowd, especially when your protection seems to be just bleeding money? How long can you endure that pain before blinking?
That really is the multi-billion-dollar question, isn't it? Patience, conviction, and cost. A fascinating deep dive into Fairfax in 2014. That wraps it up for us today.